Welcome to this edition of the Keiser Report. Markets, finance, scandal. Oh, so much scandal out there in the world of banking, investment banking, Fed chairmanship, Treasury Department secretaries. They're all colluding. They're all in it together. They're all defrauding the people. Unemployment is skyrocketing. Oh, did you see the unemployment numbers in the UK? Oh, yeah, they're looking bad. Did you see that the UK economy is now sinking like a rock? Because of defraudment in these banks. Shame on you, bankers. Well, to help us sort through all this, we've got the lovely Stacy Herbert. Stacy.
Hi, Max.
Oh, hi. How's it going?
Actually, a headline reads that Labour's borrowing means UK deficit could beat Greece. So that could be the next Greece.
Impressive.
But I wanted to talk about last episode, we mentioned the happy conspiracy insiders who are the top 1 million Americans who are preparing for Armageddon, economic apocalypse. And they're withdrawing to their bunkers and getting ready. Remember, Barton Biggs in his book suggests shooting the hordes, killing them first before they can get to your goods.
Oh, Lord.
Well, I have some evidence that the billionaires are currently at war. They're shooting economic weapons at the hordes. Headline reads, IMF backing gold market. So the International Monetary Fund plans to sell 191.3 tons of gold on the open market, they announced, after markets closed in New York. And the headline then shortly followed after, gold futures drop sharply on IMF sales. So remember, in the aftermarket, the only people who populate that are insiders, governments, and, the big guys. And the markets dropped, the gold price dropped by 1.6%. As soon as real markets opened again, the price skyrocketed.
I smell a rat. Well, remember Gordon Brown sold half of Britain's gold at $250 an ounce, a multi-decade low. So these people who supposedly know something usually know nothing. The IMF, of course, is making a big boo-boo if they hope to collateralize any kind of special drawing rights or do anything productive going forward if they're going to get rid of all their gold. Meanwhile, India, they just bought 100...
Well, they bought the last 200 tons on an off-market sale. So the IMF is now saying they're going to do this on-market. And why would they want to why would they want to scare people out of the market? And that's what many people argue, that gold is the only honest money in the world. In a world now just filled with fraud, fraudulent derivatives, fraudulent fiat currencies, fraudulent governments, fraud everywhere. So I want to take you back to the end of last month at Davos.
Take us back to the end of last month.
To show you what the IMF may be doing. They may have taken a page out of George Soros' book. Davos 2010. George Soros warns gold is now the ultimate bubble. And this is a headline from The Telegraph at the time, the end of January 2010. Gold is now the ultimate bubble, billionaire investor George Soros has declared, sparking fears that prices for precious metal may soon suffer a tumble.
Yeah.
Cut to now, George Soros buys gold despite dubbing it the ultimate bubble. So in fact, while he was saying that, he actually doubled his gold holdings and bought 11,000 call options.
That's a lot. Yeah, I challenged George Soros to come on this show and debate me. I know he won't because he's an intellectual lightweight compared to my understanding of how these markets work, because we actually show how the market frauds are committed. He's just playing the media game by going to Davos and using it as a bully pulpit to talk up his position. He's using it to manipulate his own profits.
Well, but also the headline when George Soros, the most famous hedge fund manager in the world and history, is saying gold is in a bubble and you should get out, it's a disaster, that got big headlines through all the media. The fact that he actually doubled his gold holdings is just being reported in the financial media. It's not the same people who sold out won't be necessarily seeing this headline.
The problem with Soros is that he has Jim Rogers envy. Because I think Jim Rogers is kicking Soros' butt in the investment arena in the last 10 years, and Soros is out there trying to get a date with Sharon Stone. He should be managing his money.
Well, and so what do the rich possibly know? Why are they buying all this gold? Why are they trying to shake people out of their gold positions at this point? Headline reads, U.S. bank lending falls at fastest rate in history. This is bank lending in the U.S. has contracted so far this year, 2010, at the fastest rate in recorded history.
That's right.
Lending has fallen by over $100 billion since January, plummeting at an annual rate of 16%. Prior to this, it was down at 10%.
Well, this is credit contraction or deflation, which actually creates a situation of negative real interest rates. And this is what's driving the price of gold, actually, because if you take the CPI and you subtract it from the rate that the Federal Reserve is offering, you end up with a negative real interest rate. It's like buying a CD at a bank and locking in a loss by the end of the year. You're locking in loss of purchasing power. And whenever these currencies go through a period of loss of purchasing power, of course, people go into gold as a way to safeguard their purchasing power. And obviously, guys like Soros and also Paulson, John Paulson, who runs a huge hedge fund manager, and Paul Tudor Jones, they're also buying gold hand over fist because they realize that after the deflationary collapse comes the hyperinflationary tsunami.
But what I'm also saying is that the economic apocalypse is upon us because these numbers, the U.S. lending numbers and the M3 numbers, the M3 broad money supply numbers, has contracted at a rate of 5.6% in the last 3 months. And this signals future deflation. So if you think it's already bad now, today, it's going to get worse. And this is what the insiders, the happy conspiracy insiders, the very wealthy, know about. And that causes chaos. Next headline, credit markets flash, hottest warning signal since crisis. So European credit markets are flashing the most serious warnings as the cost of borrowing, the cost of insuring bonds has jumped severely since 2009.
Right. So the global deflationary collapse is affecting all these economies. And why? Because all these banks and all these economies bought the same so-called insurance products from the same banks on Wall Street, Goldman, JP Morgan, that they thought were going to protect them against a downturn. But it turns out, just like in '87, when I was working on Wall Street, we sold a lot of what was called portfolio insurance, which, of course, did nothing in the '87 crash. So now you've got a deflationary global crash. All the so-called insurance that was sold, peddled by these snake oil salesmen on Wall Street, has proven to be completely worthless.
But it's also a case of the article is pointing out that the bond vigilantes are back, and the bond vigilantes are attacking these countries across the European Union. But as we know, and as we've covered, and our Russia Today has covered, it's these products sold to Greece, which all this turmoil is being caused by, were fraudulent. You know, Goldman Sachs sold them these fictional exchange rate credit default swaps, currency swaps, and now everybody is worried that they're all fictional across the entire European Union.
Well, bond vigilantes meet gold vigilantes. Ouch! Ouch! You're hurting me! Ouch! The gold vigilantes are beating up the bond vigilantes! Ouch! Ouch! Look, the bond vigilantes are getting slaughtered by the gold vigilantes!
Well, so as we have all this turmoil happening in the lending and credit markets and sort of manipulation seemingly going on in the gold market, now we turn to the hordes that those billionaires are ready to gun down. Rich people still have jobs, poor people don't, according to this headline. So a recent study is out, and it shows that the very bottom of the labor pool, the very bottom percentile, those earning less than $12,500 a year, so the people on minimum wage, they are experiencing depression-era level of unemployment. They're at 30.8% in the fourth quarter of 2009, while the top percentile, those earning over $140,000 a year, they're experiencing full employment levels of 3%.
Well, you know, during the feudal period before the Age of Reason, this is the kind of economic model we saw. It's called feudalism. Then you had the revolutions of the 18th century, which brought about this whole new model of so-called capitalism, but that's been repealed now due to fraud on Wall Street.
That's exactly right. But also the authors of the study say that the middle classes, all the middle incomes, have, you know, the numbers suggest they're suffering a deep recession. But the very top, you know, anybody earning over $100,000, basically there's no unemployment there. So it also puts lie to the notion that there's trickle down, because there's clearly no trickle down. It looks very much, if you look at this pyramid, like a trickle up pyramid Ponzi scheme.
Yes, the trickle-up is clearly in place. This is what Barack Obama never figured out when he took office, is that the whole model is to transfer billions, hundreds of billions, trillions of wealth up to the ruling banking elite class in this neo-feudal model. And I still don't think he gets it yet.
Well, I think probably because everybody in Washington, anybody who's working, anybody on Wall Street, all of his friends, all of his lawyers, there's full employment there. So unless you go out and see somebody earning $12,500 a year, or if you're earning $20,000 a year, the unemployment levels are 19.1% according to the study. So unless you meet those people, you're not going to see that there's actual real very, very bad suffering. And this includes income from unemployment and sort of welfare checks.
Well, you know, our friend Dmitry Orlov, who wrote that brilliant essay about the collapse gap, talking about the collapse of the Soviet Union is prelude to a collapse in America, and we're seeing that in America now for the same reasons. America's bankrupted itself on specious war interventions and genocide committing in places like Iraq, and now they're in Afghanistan, and now they're saber-rattling in Iran. With what? Borrowed money from China? Meanwhile, China's saying, we're not going to lend you any more money. Where are they going to get this money from? Well, they're going to print it up in the basement. That's hyperinflationary.
And I have one final headline regarding this unemployment situation. So, because, as you mentioned, the United States and all the states within it are going bankrupt, they're having to release prisoners early. But, unable to get jobs, freed inmates return to jail. So recidivism rates are likely to rise as jobless rate for ex-cons may be 60%. So they're being released from prison because the states can't afford to keep them in prison anymore. And yet they go out into an economy which is in a Depression-era situation. So they're committing crimes to go back into prison so at least they have some meals.
Well, remember, Stacy Herbert, the reason the terrorists attack is because they hate our freedoms.
Apparently. But so they point out that 1 in every 31 Americans were on probation, in prison, or on parole in 2008.
Not much freedom there. Okay, well, thanks so much, Stacy Herbert.
Thank you, Max.
Don't go away. We're coming right back right after this.
The close-up team has been to the region where the first Russian town in Siberia was founded. Now, RT goes to the center of northern wooden architecture, where the best Russian flax is produced. And even the harsh winter doesn't prevent people from open-air entertainment. Welcome to the Volga region, Russia Close-Up on RT. A small model, created in boyhood days, it captured their interest for a lifetime. A submarine, his own railroad, and a self-made plane. Are those just big toys, or a first step toward innovations? People that think outside the ordinary. Inventors by birth on RT.
Welcome back. Carl Denninger runs the influential blog Market Ticker, or CSI Wall Street, as I like to think of it. It's a real forensic accounting of the frauds and scandals we've seen on Wall Street and around the world. Carl Denninger, welcome to the Keiser Report.
Hi, Max. How you doing?
Now, Carl Denninger, has the second wave of the global credit crisis begun? And if so, how will it look different from the first wave?
Well, I think it has. I mean, we've now discovered that the vampire squid, that's Goldman Sachs, of course, has had their hands in the pie over in Greece, maybe in other places as well. There's allegations that there have been raw book cooking associated with Greece's entry into the European Union. Certainly, it looks like the same sort of book cooking and scandal that led to the subprime meltdown and the losses on all of those worthless securities. Just now we're looking at it from a standpoint of sovereign credit and nations as opposed to individual firms. So, yeah, it looks pretty ugly, and frankly, I think the EU has a major problem on its hands here.
All right, so the subprime meltdown, in retrospect, it's obvious it had mostly to do with fraud on the part of Wall Street banks who were engaging in all kinds of accounting, double dealings, etc. And most egregiously, they just moved billions, if not trillions, of the toxic debt onto the government's balance sheet using the same tricks, and now these sovereign credits are at risk for the same reason. So they just moved, it was a bit of a shell game. They just moved these bad debts from the private banks and the private sector over to the government banks and the sovereign banks, and now those banks are falling apart. Now, just to explain a little bit, not to get overly complicated, but I think people are interested in the actual nature of the fraud, allegedly, quote unquote, that these banks are committing. So can you run us through just a step-by-step? I guess it kind of revolves around a credit default swap, for example, as the primary unit of fraud. But if it's possible, can you run through how typically the debt is hidden and how the fraud is committed?
Yeah, the essence of the problem within the corporate structure was that we had these things called synthetic CDOs that were created by Wall Street as a means of people being able to satisfy their demand for higher yielding securities because people didn't like the fact that treasuries really don't make all that much. The problem with these things is that a synthetic CDO is created when somebody comes to an investment bank and says, I want to short a particular instrument. So what you have here is a thing that throws off cash that they then turn into the essence of a bond. It looks exactly like a bond to an investor. What they didn't tell the investor, Max, is that the reason that thing exists is because somebody believes that whatever it is referring to is going to fail. Now, this is different than an IPO or selling a bond in a corporation where the general premise is that the company is going to pay or the stock in that corporation is going to be successful. These things exist because somebody believes that, in fact, what the person is buying is going to be worthless. So you're out there selling something that the person who caused you to create this thing thinks is going to be a zero. And now we've seen the same sort of thing happen here with Greece. Greece allegedly purchased some swaps from Goldman Sachs, which allowed them to say that they had less debt than they really had. And in essence, what occurred is they took some liabilities, some things that they were going to have to spend money on, and pushed the recognition of that spending off by years, allowing them to show a smaller deficit today than was in fact the case. The problem with this, of course, is that when they went to sell their bonds, it presented a false view of the nation's finances to the people who bought them. So they thought that the nation was in better financial shape than it really was. And this is the same scam, essentially, that was run with subprime and all of these other instruments. You're misrepresenting the quality of what's out there, but you're doing it by omission. It's what you're not telling people as opposed to what you are.
Okay, you're selling them a synthetic CDO, which the value is going to increase when you short that synthetic CDO, which is guaranteed a profit to the seller of the synthetic CDO if, in fact, they explode the synthetic CDO. It's kind of like a suicide banker.
No, not quite the same. Not quite. Essentially, what you have is a hedge fund that goes to an investment bank and says, I believe that the people who have these subprime mortgages will not be able to pay. So what I do is I buy a credit default swap on these subprime mortgages. A CDO,
right, which is the same thing as like an insurance product.
In a sense, yes.
Okay.
But here's the thing: a CDO can be formed out of anything that generates cash flow. So what you have here is a hedge fund that is essentially paying the investors in the CDO. But now, why would the hedge fund flush money down the toilet, which is what they're doing if these bonds perform? That's obviously stupid. The only way that the hedge fund will make any money is if the CDO investors lose their shirts. So, but that's not disclosed to the people who bought this thing. So essentially what you have here is the wise guy says, I have analyzed this and I think that these particular investments are worth nothing or very little. And yet the investment bank is out there peddling these things as good securities when the guy on the other side created that security on the entire premise that they're going to lose everything.
Okay, so the only reason you would create a synthetic CDO is to screw up the existing CDO.
No, the reason you created a synthetic CDO is that you want a way to be short something, and there isn't a good way to do that. But the people that you sold that synthetic CDO to are not told up front in the offering prospectus, oh, by the way, the whole reason this thing exists is that the guy who created it thinks you're going to lose all your money. Okay. Now, would you buy something, Max? If I came to you and I said, I have this great stock, I want you to buy it, it's $10 a share, but I think the company that issued it for $10 a share is going to go bankrupt and you're going to get zero, would you buy that stock?
No.
Well, but that's the essence of these synthetic CDOs.
Right. Okay. So now in an economy that we're talking about here, the global economy, which is based on a fractional reserve system, it's based on a fiat currency system, it's based on derivatives, and then you've got collateralized debt obligations that are derivatives, and then you have synthetic collateralized debt obligations, which are bets on bets on bets. And at the end of the day, what you're talking about here is that the people who are selling these products know in advance that the value, it's a guaranteed profit if they're colluding with their brethren out there in the hedge fund industry to make sure that there's a profit at the end of the tunnel, so that it removes completely this idea of the risk-reward ratio. In other words, in capitalism, you'd expect for someone expecting a reward that they're taking some kind of risk. But what you're describing is that these bankers are taking rewards, but they're not really taking any risks at all, right? They're not taking any risks at all. This is guaranteed profits.
Well, the bankers, if they do things correctly, are not supposed to be taking risks at all. They're skimming off a fee for creating those things. The person that's taking the risk is the hedge fund that says, I believe that these securities are going to blow up. If he's wrong and they actually perform, he's going to lose a shirt. But the people who buy these securities believe that these assets will perform, otherwise they wouldn't buy them. And the problem here is the reversal of the normal role. That is, normally we create securities when we think something good is going to happen, not something bad, because the people who buy them are betting on the good. In this case, we're creating securities because the person who causes them to be created believes that they're bad, and yet the person you sell them to wouldn't buy them if they believed they were bad. So we have a reversal of the usual role in the capital markets. But the banks don't care one way or another. They're agnostic on this. They get a fee for these things, a huge fee. In the case of Goldman, I think it was reported they made something like $100 million dealing in these swaps with Greece. They didn't care whether Greece got caught and whether Greece's debt performed. All they cared about was they got a huge fee for arranging the transaction. So essentially what you have here is you have a drug dealer, in a sense, on the street. He doesn't care whether the drugs are beneficial, i.e. penicillin to treat some infection, or whether it's crack cocaine, as long as he gets his slice of the transaction. He could care less who wins and who loses. He just wants his fees.
Okay. Now, underlying the whole market, the CDO market, for example, has been this pool of mortgages and the housing market. Is the collapse in the housing market over?
No, not even close, Max. Look, we still have, in this country right now, we still have ramping delinquencies. We still have ramping defaults. We have banks that are refusing to take losses. They're letting people live in houses for a year, sometimes 2 years, without making a mortgage payment. This is propping up the general economy because obviously if you have a $3,000 mortgage payment, you don't make it $3,000 to spend on cruises and dinners out at expensive restaurants, and maybe you can buy a new car even though your credit is ruined because you're not paying your mortgage. So we have an economy that has been distorted dramatically by the actions of these banks and the Federal Reserve. By the Fed buying up all these mortgage-backed securities, they've prevented the market from recognizing the true value on these, which is that there are huge losses embedded in these things at the present time. None of this has been recognized as of this point.
Right. So it's a fair estimate to think or to say that the housing market in the U.S. could experience another 30 to 40% decline.
I'm looking at somewhere between 20 and 25. My original estimate back in 2007 was that the total losses in that segment of the lending market would be about $3 trillion. We've seen about $1 trillion of that so far. So there's $2 trillion left to go. If they can manage to keep $1 trillion under the rug, there's still $1 trillion left to go. The Fed has bought about $1 trillion worth of mortgage-backed securities. So if we take that out of the picture, we're half done.
Right, but as we've been talking about, since these things are so highly leveraged in the derivative markets, for every 10% decline in the asset value underlying these asset-backed securities, you're talking about 50, 60, 70, 80, 100% wipeout. And this just gobbles up all the money, and it turns into this cesspool of an economic nightmare that you've been writing about with great detail on your site. Now, you recently talked about the 30-year U.S. Treasury debt auction basically failing.
The United States has a rather unique structure in that we technically cannot have a failed Treasury auction because we have a network of primary dealers that are obligated to take down whatever supply the Treasury decides to issue. So when you see a bid to cover, that is effectively a failure because you have an obligated party to buy those bonds, whether they want to or not. So what you have to look at is other metrics. And in this case, what I look at is the indirect representation, that is foreign central banks and other registered parties. I also look at the amount of tail, or in other words, the spread between where that auction goes off and where that reference is trading just before the auction results are announced.
Right.
But exactly who are those direct bidders, we don't know.
Okay, we're running out of time. Quick question. Can the U.S. default on its bonds, yes or no?
Yes, but it probably won't. My best guess is that if there is a default, it would be selective, and it would be associated with something that we consider to be either outright aggression or some sort of economic, what would be considered economic warfare. We've done this before when we had the little dust-up with Iran many years ago. They essentially froze Iranian assets that were held in custody by the Fed and by other banks. We could do that kind of thing again, say, for example, to China, although the reaction could be rather violent if we did.
Okay. Thanks, Carl Denninger, for being on the Keiser Report.
Anytime.
All righty, and that's going to do it for this edition of the Keiser Report. I want to thank my guests, Stacy Herbert and Carl Denninger. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.